Okay, everybody. Hello and welcome to our second webinar of fall 2024. I'm Rachel Helms. I'm one of the assistant directors here at Alumni Relations at Middle Tennessee State University. Today, our topic is mortgages. We are so happy you could join us during your lunch hour on this lovely October Tuesday. We are grateful for our continuing partnership with the Ascend Federal Credit Union. Our featured speaker today is Ryder Aguirre. Ryder serves as a mortgage loan originator for Ascend, where she's passionate about helping homebuyers realize their dream home. She's also an active member of the Rutherford County Chamber of Commerce. Just a couple of housekeeping notes before handing over to Ryder. You should have all received the handy participants guide via email. If not, it's dropped at the very top of this chat session for your review. We'll be monitoring the chat for questions, so feel free to send questions at any time. If a question is a little more involved, we will get to it. We may just hold it till the end of the presentation. So Ryder, thank you so much for being here. I will turn it over to you.
Awesome. Thank you guys for having me, and thanks for everybody tuning in. Just to kind of give general ideas of what to expect today, this is just a general mortgage webinar. I think Rachel had let me know there were some specific questions that came in about rates and refinancing and things like that, which I'm more than happy to get to, but they're not super addressed in this webinar. So if you have questions about that, put them in the chat and we can address them. But just in case anybody that's here is not familiar with Ascend, just to give you a little bit of background on that, we are a not-for-profit financial cooperative owned and operated by our members. Our headquarters is in Tullahoma, Tennessee, so not too far from here, and we serve members all throughout Middle Tennessee. With more than $300 billion in assets, Ascend is the largest credit union in Middle Tennessee and one of the largest federally chartered credit unions in the United States. And we'll talk about it a little bit, but just some main differences between credit unions and banks. As I mentioned, the credit union, we are member owned and we're not for profit, whereas banks, they don't have members, but they have customers. And their main goal is to maximize the earnings for their shareholders. Credit unions are also typically going to have better rates and fewer fees when it comes to loans, even some interest earning accounts that we have. And then we also typically are able to have more flexibility on what we offer compared to banks just because we are locally owned. But today, just like Rachel said, we're talking about mortgages. So if you're thinking about buying a home, more than likely you are trying to figure out how you're going to afford to buy this home if you don't have cash in hand to buy it outright. And so with that, you're going to need a mortgage. There are many reasons that people might want to buy a home, whether it is to raise a family, maybe you want to have a permanent address, maybe you are wanting to provide some security for the future, to move upward in life, or to create wealth or increase your assets. You can increase mine if you want as well. But if you have any, whatever your goal is or reason for wanting to purchase a home, it is something good to reflect on because it's a good motivator to figure out what you need to do, what steps you need to make to reach that goal. So most people today actually don't buy a home straight with cash. About 86%, according to the National Association of Realtors, have to finance a home. So in this workshop, we're going to be talking about different types of mortgages, common costs that are associated with those mortgages, what options you have as far as loan products go, and then how you can actually start that application process. And again, if there's any questions throughout, I'm going to try and monitor the chat. I know Rachel's going to work on it as well, but feel free to put those in there. If we don't get to them now, we can get to them at the end. So getting a mortgage or buying a home is already a pretty stressful situation, especially if you've never done it before, or maybe if you haven't done it in a long time. If you've owned your home and are now thinking about purchasing a new one, things have changed over the years. Obviously, rates are a little bit different, processes are a little bit different, so it can be very stressful. But knowing what that process is and what's included in the mortgage can definitely help to alleviate that stress. So a mortgage, we're going to figure out exactly what that is. It is a loan that you take out to purchase a property. So for example, if you're wanting to buy a home that costs $100,000, you have $10,000 saved to put towards this purchase, you're going to need a loan for $90,000 to pay that seller what they're asking. While the total amount of your mortgage might be very high, You won't be paying it back all at once. Just like any other loan, you're making monthly payments typically for a certain amount of time. There are several costs that are involved in borrowing funds and repaying that mortgage, in addition to the actual monthly payment you have to make. So we're going to talk about what goes into that payment. So some of these terms you probably are familiar with, but what goes into a monthly mortgage payment? You have obviously your principal that you pay, the interest, property taxes and homeowners insurance, which if you roll those into your mortgage loan or mortgage payment, that's called your escrow. And then some loans require that you have private mortgage insurance, or PMI is what it's called. More than likely, you've heard at least the terms principal and interest when talking about any other kind of loan, whether it's an auto loan, student loan, credit cards, those are familiar. Property taxes, everyone's a little bit familiar with those. Homeowners insurance, again, familiar concept. But now we're going to go through some of these that are just kind of break down exactly what they are. So for your principal, the principal is the original amount that you borrowed. It needs to be paid back in full. So again, if I lend you $90,000, you pay me $50,000, you still owe me $40,000 of that principal balance. So I'm expecting you to be paying that in full. As far as interest rates go, the banks, they earn a profit when they lend you money. So they do this by charging you for the funds that you borrow, which is your interest. Your lender is going to determine an interest rate, which is a yearly percentage of the principal that you owe. And the higher the interest rate, the more you're ultimately going to be paying each month. Then we're going to get into our red terms here. Down payment. A down payment is the money that you use from your own funds, and some loan options might allow you to have gifted funds as well, but it's funds that you use towards the purchase of a home. So again, going back to that $100,000 purchase price, if you have $10,000 saved to put towards this purchase, that $10,000 is your down payment. Different loan programs are going to require different minimum down payment amounts, but regardless of the programs that you use, typically you're going to see that requirement as a percentage and not so much a dollar amount. So it can be as low as 3.5% and then as high as 20% typically. Then we get into our private mortgage insurance. Private mortgage insurance is something that's required on some loans. It typically is required if you're putting less than 20% down. It is something that doesn't necessarily benefit you. It's different than homeowners insurance, but what it does is it's an insurance that covers the lender in case you are not able to continue making your mortgage payments. Usually, it'll fall off after a certain point of time, depending on the loan product, but some loans require that it's on there for the life of the loan. And generally, your PMI is going to cost around $30 to $70 per month for every $100,000 that you borrow. And it can take anywhere from 5 to 7 years to fall off on a conventional loan, depending on what kind of payments you're making. And then, like I said, after it reaches about an 80% loan to value, it'll fall off. And then we get to discount points or mortgage points. This is a term that probably everyone here has maybe heard of or is familiar with. But basically, when a bank presents the interest rate to you, it might offer the option to buy down the rate or buy points down on the rate. What this does is basically the fee that they call points also is a percentage of whatever that loan amount is. So the word point and percent are the same thing. So for example, if the lender tells you, okay, the base rate right now is at 3%, but if you pay a quarter of a point, then I can offer you 2.75%. So that is the same thing as saying the base rate is 3%. If you pay a quarter of a percent of your loan amount, then I can give you 2.75%. Not all lenders offer this option, and not all loan products have that availability for buying down points. So something to ask while you're shopping around. And then, of course, another costs that are associated with a mortgage, there's other fees that are thrown in there. Some of these are going to include the appraisal that's required for every mortgage. And this ensures the value of the home that you're purchasing. Title insurance is to guarantee that the seller actually owns the home that they're selling and that there aren't any outstanding liens either from the current lender or previous lender. And typically, owner's title insurance is optional, whereas lender's title insurance is always required. Then you have attorney fees, typically in most of that, which is associated with title fees, any bank-related fees, as well as any government fees that are associated with transferring deed and title. So when you apply for a mortgage, your bank will provide an estimate of all these costs so that you'll kind of know what to expect. Typically, that comes with your pre-qualification letter. And then if you guys have your packets with you, on page number 3, there's just a little calculation there that you can use to kind of get your head in the space of knowing what kind of down payment you would need. On page 3, it gives the example of you have a home value of $100,000. Your down payment requirement is 30%. How much are you going to need for your down payment? $30,000. So it's a good way to kind of figure out if you're trying to save for a down payment, what do I need to save? What's my starting point? If this is the kind of purchase price I want, how much do I need to save? So there are many aspects of getting a mortgage. Knowing what to prepare for and planning ahead are going to make the process a lot easier when you're actually ready to start the process. So even if you're just thinking of buying a house right now, it is never too early to start getting yourself prepared for the actual application process. The more time that you have to get yourself ready, the stronger of a buyer you're going to be when you're putting in offers. So we're going to start by discussing these main points. The first one is to make a budget. This one's pretty intensive just because a budget is really helpful and very important for you, especially if you've never purchased a home before. Knowing how much you earn, how much you spend, and how much you're able to save can help you figure out how much of a mortgage and down payment you can realistically afford. On paper, it might be one thing, but realistically on your day-to-day life, it's a completely different thing. So adjusting your spending and your savings habits now are going to, again, help you in the future when you're ready to start that process. And it could also help you to improve your credit score if that's something that's needed. So some questions for you to think about, have you ever used a budget before? If anybody here does have any kind of tools or apps that they've used in the past that they've really enjoyed, drop it in the chat so that other people can use it. There are tons of apps now that monitor. You can basically hook up your bank accounts to, and it monitors exactly where your spending is going and puts it in little slots for you. Some even send your extra change to a savings account and things like that. But if there's any apps that you've used in the past, or if you're a pen to paper kind of person, or if there's just some people use the envelope method for paying down debts, or they use a snowball method, anything like that that has worked for you that you think someone else could benefit from, definitely share. But when we're creating a budget, it can give you a clear picture of what your finances are actually doing. So on page 4 of your packet, there's a very simple budget worksheet. And the point of the budget is essentially just for you to be as critical as possible so that you can see realistically, can I afford a new house payment or a larger house payment than what I'm paying now? So if you have multiple people that are going to be purchasing a home with you, this is definitely something to go over with them. Both of your guys' incomes and debts need to be put in here. If it's just you going on solo, same thing. Take the time to really analyze where things are going or where things are coming from. That way you have a better picture of what actually is going on. And as you're making that, try and think about, do I have an areas that I can cut back on? Do I have subscriptions that I no longer use, but I'm still paying for? I definitely am guilty of that. Or am I spending more money on food, eating out than I typically need to, or that I realistically need to? Or is my recreation spending a little bit too much? Do I have room to start saving for a down payment? So things like that you can start adjusting now so that when you're ready to purchase, again, you can just be a stronger buyer. So how can you use budgeting to improve your ability to get a mortgage, and what else can you do to prepare before you apply for a mortgage? We're going to get into that as well with these following steps. So preparing for a mortgage does involve budgeting, as we discussed. It also involves research and then, of course, getting that pre-approval. So as we go through these steps, you have the worksheet on page number 5 of your guide to check off the steps that maybe you've already taken. Or there's even a little slot in there where you can plan when you want to have that step check marked. That just kind of keeps you on track to reach your goals. So as we discussed in point 1, we want to make a budget, cut down on expenses, pay off any debts that we have, understand what monthly housing costs we can afford. And then we get to number 2, you want to find out what your credit score is. A lot of people have apps, same thing, that monitor their credit score, some specifically from the credit reporting agencies. I think a lot of financial institutions provide them on like checking accounts. Credit cards typically have them. But you want to find out what it is. That way you have a starting point. And if possible, get an actual report. That way you know what's reporting to your credit. On page 5, there's 2 places that it mentions in point number 2. You can go to myfico.com, which is a small fee for that. And then there's vantagescore.com, which that one gives it to you for free. And then a little bit later, there's a third one that you can go to as well that has a free report. You get a free, I think it's an annual free report that you can pull from. You always want to make sure wherever you're checking your score, it's giving you a numerical number because that is what the mortgage lenders are going to pull from. Something to kind of think about if your credit score is poor, and that is, we'll talk about that a little bit more as well, but under 670 or under 660, that's okay. The biggest thing to help your score climb as quickly as possible is just to make sure that you're paying all of your bills in full and on time. And when I say in full, I'm not saying pay the full balance, but you're paying that minimum payment in full. You're not doing little half payments, and paying them on time really will make such a big difference. But we'll talk about credit a little bit later. Point number 3, we want to improve the credit if necessary. If you are proud of your credit and you know it's a good score, then you've got that checked off. If there are things that maybe you need to work on, maybe there's collections on there that you know about, or maybe there are late payments you're waiting to kind of fall off so that your credit score can go back up, keep those in mind. Point number 4, we have collect documents. Typically, your lender is going to go back 2 years on most of the documents that they're going to ask for and the information on the application. So tax returns, if you're self-employed, we need 2 years. W-2s, that's 2 years. Pay stubs, you do not need 2 years. You only typically need 30 days worth of pay stubs. Employment history, we have to go back a full 2 years of employment history. So if you've jumped from job to job, definitely having your resume on hand would help because you're going to have to provide the start dates and end dates typically on the application. And then bank statements, we don't go back 2 years. Typically, we go back 60 days or quarterly, depending on the type of account that it is. Back to your guide, if you look at pages 6 through 8, there's a bunch of other checklists that you can use that just kind of have you provide information that your lender is going to ask you for on the front end of things. So it helps you to already be ready with that information so you're not searching around for it. All right, now getting back to this. So we want to calculate our home affordability, which is point number 5. Looking at your budget after you filled that out, see how much money you have every month after paying your monthly debts. What's left over? That's what you can use towards your mortgage payment. Then you can go use a mortgage calculator, which they provides here on the website, mortgagecalculator.org. You can put in a purchase price, whatever rate you can find. It tells you what your payment is. If the payment's more than you have left, then that's going to be too high of a purchase price, or you need a bigger down payment. But remember, you're also going to have to pay your property taxes and insurance with that payment. So that's also something to take into consideration. Depending on where you purchase, that can be anywhere from $250 to $400 also on the purchase price. And then you have to start saving for that down payment. Once you know what you can afford, then you know how much you're going to need to save. Paying off your debts, you want to give yourself a good start to improving your credit score, which can help you qualify for those better interest rates. And doing this can also open up for a higher monthly payment, which again opens up for a higher purchase price and more buying power. And then we want to start researching for mortgage companies. Shop around. This is the biggest thing that I always tell people, even if they've been with Ascend since they were tiny. When it comes to a mortgage, there are so many options out there, and there are so many lenders that also offer very specific loan products to what their company can offer. So shop around. You never know if one product works really, really well for you, maybe just a little bit better than what someone that you're comfortable with, but you're not going to know until you ask. So definitely do that. When you're talking to other lenders, you want to ask about the fees that they have that are related to the mortgage. Does anything need to be paid up front? Is all of it in closing? That's something to know. What requirements do you have? What guidelines do you follow? You want to compare the interest rates, the loan amounts. And ultimately, you want to find a lender that you truly trust. Like we mentioned before, purchasing a home is kind of stressful. And your realtor is there to help you as much as they can. But your lender also, you want them to be someone that's going to be very upfront and unfortunately very blunt to tell you maybe what you need to work on or what needs to be paid off. That way you're not left guessing as you get closer to purchasing a home. And then number 9, you get pre-qualified or pre-approved. So some lenders will only offer a pre-qualification, where others will offer a pre-approval. And then you want to work with the lender to see what's required from you. As far as the difference between a pre-qualification and a pre-approval, they're pretty much the same thing. Both of the letters are going to tell you the purchase price that you qualify for, the loan amount that you qualify for, and it'll have any kind of contingencies or dependent on conditions for you to qualify for that amount. So, for example, if you need to get rid of an auto loan, if you're going to sell your car, that's going to be contingent upon the sale of an auto loan. Or if you're selling your home to buy a new house, it's going to be contingent upon the sale of this house. That way you have the funds for the down payment for the new one. But typically the pre-qualification, usually the lender is going to go through all of your income documents on the front end, and they're manually going over everything. Whereas with the pre-approval, it typically is run through an automated underwriter. So they kind of just gather the information that you provide and give you kind of a best efforts yes or no on that application. So those are something to think about. Now, if you're looking back at this list on page number 5, have you checked off any of these things? If you have, fantastic. If you have not, maybe set the goal to have them completed by a certain date. Or if you're just kind of in the beginning processes of looking to purchase a home, at least now you know exactly what you need to do in order to reach that end goal. So now that you have or know the steps that are involved in preparing for a mortgage, we're going to talk about the different types of mortgages. All right, so making a budget and knowing how much you can afford are important steps, but you'll also need to know the type of mortgage options available for you. So choosing the right mortgage depends on your income, on your credit, how much money you have for a down payment, and typically your liabilities are thrown in there as well, or your debts. It can also depend on how quickly you plan to pay off your mortgage or how long you plan to live in the home can be a deciding factor. But when you make a payment on your mortgage, it's going to affect your loan in just a few ways. In the beginning on a mortgage, it's front loaded to interest. So a large portion of your payments will actually go towards the interest rather than the principal. And then as you pay down that mortgage over time, a larger portion then goes towards the principal until you paid that loan off. And that's what's called amortization. Sometimes your mortgages are going to be structured in a way that your payments are actually only going toward interest for a specific amount of time, and then they'll be applied to principal and interest later on. You'll see this very popular with home equity line of credits or HELOCs. That's a very popular structure for that kind of loan, which is a second lien. You wouldn't use that to purchase a home typically. And then some mortgages have a fixed interest rate for the life of the loan, while others might have an adjustable rate or adjustable rate mortgage, or ARM, you might hear them called. So if you get a fixed rate mortgage, your monthly principal and interest payments are going to remain the same for the entire life of the loan. That doesn't mean that your total monthly payment won't change because, again, you might have property taxes and insurance rolled into that payment. So those can adjust, but your principal and interest should never adjust if you're on a fixed rate. For mortgage purposes, the word term refers to the number of years that you're going to be borrowing the money. So if you're on a 15-year term, that means you're going to be paying on it for the next 15 years. In general, the shorter the term of a fixed rate mortgage, the higher your monthly payment will be just because you're repaying the loan in fewer months. However, shorter terms tend to have lower interest rates because they're less risky for the lenders. So because of this, the amount that you'll pay in interest over the life of a shorter loan could be considerably less than a longer term. While there are several loan terms that exist, the most popular are a 30-year or a 15-year, and some lenders even offer a 20-year in there as well. So looking at our charts here, comparing our fixed rate mortgage items, some things to look at or consider for here is what are the pros and cons of each? So a 15-year fixed, if you see any, feel free to put them in the chat. But I see your interest rate is lower than it is with the 30-year. You're paying far less interest over the years. Cons, it looks like your principal and interest is going to be higher than it is with that 30-year fixed. And then we jump to our 30-year mortgage. Pros, again, you don't have such a high monthly payment. You're not locked into a high monthly payment. Your interest rate is going to be a little higher, about 0.5% higher in this case, and you're paying more interest overall. But again, this is where it comes into play. How long are you planning to stay in this home? Do you plan to pay it off early? Are you going to be making large payments to maybe get that balance down so where you're not having to pay as much in the balance where they can re-amortize that loan for you? So those are things to consider when looking at all the different loan options that you have. If you're getting an adjustable rate mortgage or an ARM, the interest rate is going to be fixed for a certain period of time, and then it can adjust every so often until the loan is either paid off, refinanced, or sold. After the initial term ends, that rate automatically adjusts either monthly, quarterly, yearly, sometimes even less than that, but it just depends on how that loan is structured. So for example, if you have a 5/5 ARM on a 30-year term, the life of the loan is 30 years, your rate's fixed for 5-year increments and can adjust every 5 years. So that's always a good option if you think you're buying a starter home. I'm only going to be here for 5 to 7 years. Maybe an ARM is a better option than a fixed rate. They typically also have lower rates, and they typically also don't require private mortgage insurance. But because that rate can increase, it's really important for you to know, if I still have this home and I don't refinance it or sell it before the rate adjusts, can I afford that higher payment? That's definitely something to talk about with your lender. And then just a quick note on payments. Most payments for all lenders, it's kind of a universal thing. The payment for a mortgage is due the first of every month. There are options where you could do biweekly payments. So your rate would still be a fixed rate like a regular mortgage, but you would be making payments every 2 weeks. So because there are 52 weeks in a year, this works out to be 26 payments, or 1 additional monthly payment per year than you'd make if you were just making them monthly, which can help you pay down that loan quicker. Something to keep in mind with that, though, if there is a third party that services the loan after it's closed, they may charge a fee for that. So that might be something to ask your lender, again, as you're shopping around, if that's a payment plan that you're comfortable with other loans. But even if you don't want to do that, if you don't want to have it set on a bi-weekly plan, you can always make payments, additional payments to your mortgage, just like with any other loan. The one thing you have to note with a mortgage loan is that you have to indicate that it's going towards the principal. If not, your lender will apply it towards principal and interest, so it doesn't really help you too much. But knowing the types of mortgages and how they're going to affect your monthly payment is a good step towards securing that mortgage loan that works for you. Another step is finding the right loan source. So we're going to talk about different lenders that are available. So where do you go to get a mortgage? No doubt everyone has either heard about, read about. I know on the freeway, you could be driving down 2465 and see billboard after billboard of someone that's willing to lend you a home. If you're a podcast listener, there are tons of lenders that push through podcasts, just the radio, on TV. There's lenders everywhere. There's no shortage of options of where to get a loan. So what are some of these loans or some of these lenders? We have on here banks and credit unions. These are both financial institutions where usually you have a mortgage loan originator, what I do, who can work with you. Different banks and credit unions have different requirements and qualifications. So what one may allow on their guidelines, another may not. And then we have our savings and loan associations, which are also called thrifts. These financial institutions provide many of the same services to customers as a bank, but they tend to place a stronger emphasis on residential lending. So there are financial institutions that function like banks, but may be organized like credit unions. So they can allow members to open accounts, they can make deposits, you can obtain a credit card or a debit card, but unlike a bank, the savings and loan associations must use a majority of their funds for non-commercial mortgages. So that means that they have to use their own funds to support customers who want mortgages to buy homes, which is similar to how the credit union works. And then you have a mortgage broker and a mortgage banker. So a mortgage banker works for a bank or other financial institution that lends you the money for the mortgage. And then after they originate that mortgage, the lender can continue to service it, or they may sell it to another organization. A mortgage broker is an agent who brings together lenders and borrowers. They don't actually make the loans, but they find a suitable lender for you. The selected lender will provide the mortgage, and they also pay a fee to the broker for the services. A mortgage broker works with many financial institutions, but charges a fee for or takes a percentage of the loan as a commission. I typically always suggest, if maybe you're looking to go the mortgage broker way, to double check who's paying that fee. Is that coming out of your closing costs, or is that just something that the lender pays? Because sometimes if you can not have to pay an extra fee for closing, obviously we want to find a way to do that. So financial institutions typically give out loans to individuals with good credit scores, and they may have some restrictions on interest rates and down payment options or other fees. But if you have poor credit, or maybe if you qualify as a veteran, other options might be available to you. So we're actually going to talk about some of those. So in addition to private lenders, the federal, state, and local governments can lend money for mortgages. We have the FHA, or Federal Housing Administration, is one of those federal agencies, which is part of the U.S. Department of Housing and Urban Development, or HUD, which approves lenders and loan products. HUD's main goal is to make sure that the affordable housing options exist for anyone who wants to rent or buy. And so to achieve that goal, they run programs through the FHA to help individuals who may not qualify for a conventional mortgage. And then we have our state or local housing finance agency. So most states have a housing finance agency to provide affordable loans and housing options to their residents. The National Council of State Housing Agencies oversees all of those different organizations that might offer those loan programs. If you belong to a special group, such as maybe you're a veteran, or if you're a first-time home buyer, or if your income is below a stated amount or within a particular range, you might be able to take advantage of some of these programs. You can definitely reach out to, I think it's on one of your pages, but ncsha.org. So you can find out what kind of local programs are offered here for home buyers. So if anyone has dealt with any of these loans, it's always an interesting process. The federal housing or the government funded loans tend to work a little bit differently than the conventional loans or private lender loans, just because there's typically more fees associated with it. And their guidelines sometimes can be a little bit more lenient, but on the flip side could be a little bit more strict than going with just a private lender. So apart from lenders, federal program products and resources are available to help home buyers navigate, secure, and manage their mortgage. So you can even get help with your down payment if you qualify with some of these products. They each have their own requirements and terms. So as we take a look at them, think about whether maybe your circumstances fit you into one of these boxes where this kind of loan could be good to use. So we have first our FHA loan. These are still very popular right now. A lot of people are tending to go this route just because down payment requirements. So the FHA helps to insure your loan so you're able to get a better deal through a private lender, such as a bank or a credit union. But if you don't have a long enough credit history, for example, if you've recently immigrated or maybe you just established credit, you may still be able to apply for the FHA loan. FHA loans can be more expensive than conventional loans just because of the additional fees that are associated with them, but that's something you would want to ask your loan officer. Key notes about FHA loan: the down payment requirement is 3.5% always. It doesn't matter what your credit score is. They also require PMI, or that private mortgage insurance, for the life of the loan. Unless you put, I believe it's more than 10% down, then it's required for only 11 years. And then we have our Fannie Mae and Freddie Mac loans. So they offer programs that are targeted specifically for people who are first-time home buyers, are low to moderate income buyers. They might belong to a certain profession, such as their teachers, their first responders, their healthcare workers, or maybe you need to include other people's income to qualify for the loan. A lot of private lenders and conventional loans typically follow guidelines for either Fannie Mae or Freddie Mac, or sometimes both. Ascend, we were Fannie Mae, now we're kind of slowly moving over to Freddie Mac, but you'll hear those names pretty often once you start shopping around. And then of course we have the VA. If you are eligible, a VA loan can be used for eligible veterans, service members, and even surviving spouses, which is really great. The VA basically guarantees a portion of a loan from a private lender. The type of program you qualify for can depend on the length and status of your service. And then you'll need a certificate of eligibility, or COE, once you apply. And that's something you can either get online, or you could also you could go into the VA and they can give it to you, or your lender could always ask for it as well. And then you have the USDA loan, or rural development. So for those looking to buy homes in rural areas, the USDA offers several types of loan assistance, both direct loans and guaranteed loan programs. There's a Section 502 direct loan program, assists those who may have a difficult time qualifying for traditional loans. For the direct loan program, your income has to be within certain parameters. So it has to be less than a specified amount, which typically varies depending on where you live and how many people are going to be living with you. So that's, again, something to ask your lender about. The property that you're purchasing with this kind of loan has to be your primary residence, and you have to be a citizen or eligible non-citizen. And of course, as listed on this here, there is no down payment required for a USDA loan. And then, of course, there are little down payment assistance programs that are offered through local governments, through the way of grants, or private loans or hidden loans that you might see. So again, going to either FHA.com or HUD.gov, you can see what kind of programs are available in our area. All right, so now that we know all the different kinds of loans that we have, we're going to go through what you should do once you're ready to start the process. So whether you're ready to get a mortgage or you're just thinking about it, here are some steps we can take. So again, we want to find out what our credit score is. That's kind of the most important, because that determines what kind of down payment requirement we have, what loan products do I qualify for, and you want to know what your debts are, things like that. What kind of interest rate could I qualify for? So on here, it has those two that we listed before, the MyFICO and the Vantage score. And then that third one is the one I typically use, which is annual credit report. You can pull your credit. It's a soft pull. You get all 3 credit bureaus. And it's free, gives you a full report, which is kind of great. I think you can do it once a year. They might have even upped it to twice a year now. But those are a good place to start if you just don't know what your score is. As I had mentioned before, different bureaus have different ranges for a good credit score, but according to FICO, anyone with a credit score above 670 has good to exceptional credit. So if your credit's not great, there are definitely things that you can do. So you can work on paying your bills, as I had mentioned before, in full and on time, which means making that full minimum payment. That's the quickest way to improve your credit. If you're looking at a report and you notice maybe there are late payments that were not actually late payments, or maybe you think you might be a victim of fraud, first thing to do is to contact the credit bureau agency. So that's Equifax, Experian, or TransUnion, and let them know. That way they can either amend it or put a note on there. That way, should someone pull your credit again, there's an alert on there. And then you want to reach out to the lender that's reporting the error, so they can do the same thing. Then there are also credit repair organizations that might be able to help remove fraud or incorrect notes on your credit report, but I would just do your research on those. That unfortunately is a very easy way for people to commit fraud by going through the credit repair organizations. It tends to be a big scam. So just make sure you do your research and it's a trusted company. And then we get to our step 2. This says to aim to save up to 20% for the home's value. 20% might be a lot depending on what your financial situation is. So again, it can be anywhere from 3.5% up to 20%. So if 20% is out of field for you, maybe shoot for 3.5% so you can qualify for FHA. But something to remember, the larger your down payment, the better interest rate you could have, also the more you could qualify for. Step 3, we want to compare the cost. So once you're going through all of these different mortgage lenders, they've sent you their fees. You want to look at the differences. Does someone charge me an underwriting fee and the other one doesn't? Is my credit report fee higher with this lender than it is with the other lender? Am I buying points and they didn't really tell me about that, but I don't have to buy them with another lender? All things to look at and compare. And again, just to note, your lender, you want them to be someone that's very upfront with you. They're not trying to hide anything. It's a very big purchase and it's kind of a stressful situation. So you want to have someone that you trust, someone that you're comfortable with. All right, so now, so you know how to prepare yourself for the mortgage. Now we're going to talk about actually securing or applying and securing the mortgage. But at this point, you've progressed to where you can contact lenders to get your mortgage started. So here you've received your pre-qualification or pre-approval. You've narrowed down the list of the potential lenders that you want to use, and you have your eye on homes within your budget. You're ready to move forward. So it's time to proceed with the application process. Something to note here, typically, you're going to have your application already in to get your pre-qualification or pre-approval letter. Some lenders may not require you to provide income documents up front, and others might. So it just depends on the lender. But usually you have about 10 days to provide any documentation that they're requesting, or to at least give them some kind of intent that you're wanting to proceed with them. And then once you provide everything, all the documents that they need or the information that they need, then they're going to start moving forward with analyzing everything and seeing what kind of rate and loan product would work best for you. So now we're going to look at the process of settlement with the lender so that you can receive the loan. So the pre-approval or pre-qualification process can be super quick. Once you put the application in, sometimes you can get that pre-qual back within 24 hours. Depending on circumstances, it might take 48 days. Usually those are good for about 4 months. So if you're planning to purchase, it's dependent on a lease of when you want to close your home, kind of plan for that. You have about 4 months. I always typically say have about a month of a buffer in case your closing has to get pushed for any reason. That way you don't have to worry about them needing to repull credit or anything like that. But they're going to use all that information that you provided to them to basically figure out which loan is best for you, what's the best fit for you. So what kinds of questions, once you're looking or once you've kind of gone with a lender, you're narrowing them down now, what questions do you want to ask while you're getting pre-qualified? Or what are they going to ask you, when you're getting pre-qualified? Like I'd mentioned before, they're going to need to know what your income is. They're looking at annual income. They break it down monthly. Income is salary. So if you're a W-2 employee, that's your W-2 or pay stubs. If you're paid hourly, same thing. If you earn money through tips or commission, we need 2 years of tax returns to show that. If you're self-employed, same thing, 2-year tax returns to use that. Do you get money through investments, whether that's stocks? Do you regularly pull from that? Do you have rental properties? Typically, we need 2 years, but in some situations we don't. Do you earn Social Security? Do you earn disability? Do you have any unemployment compensation? Do you earn a pension? Do you earn or pay alimony or child support? If you earn it, if it's continuing for 3 years, we can use it. If you're paying it, that is something to let your lender know because it needs to be counted in your liabilities. And then if you're earning money overseas or abroad, maybe you have family or something, and that's somehow you're getting income from that, typically we can include it. But again, the documentation is going to have to be pretty solid for us to include that. Things that are not income would be any kind of loans that you have, or any monetary gifts from friends or family. That does not count as income. You can put it in your assets into your savings, but it's not income. They're also going to want to know about your assets. Do you have savings accounts, checking accounts, any certificate of deposits? Where are you pulling the money to buy this house from? That's what they'll need to know. They're also going to need to know if you lost your job, do you have funds to fall back on to continue making your mortgage payment? So those are some things to think about when it comes to assets and savings. Your checking accounts you can add in there, saving bonds. Those aren't very common now, but some people still have them. We can add that in there as well. And the more assets that you have, the stronger the file is. So if you're a first-time home buyer, that definitely helps. And then as far as debts go, most of that they're going to pull from your credit report when they do the credit pull. That's going to pull any kind of existing loans that you have, credit cards that you have. There might be additional things. Again, are you paying any kind of alimony or child support? If you have a leased vehicle, that's something to mention because that does not pop up on your credit, but we need to count that because it's something that's a necessity to you to have a car. So remember, the pre-approval or pre-qualification does not mean that you are or will be approved for the loan, but it's a good way to get an idea about what you can afford, and if there's anything you need to work on in the meantime, you can start working on that now. So now we're going to look at a loan estimate and see what that looks like. So the next step is where you're going to receive that loan estimate and choose the loan to apply for. So once you put your application in, you found a home, you're just about to be under contract, you can ask for a loan estimate at any point in time once the application is in. But typically once you're under contract, that's going to have the most realistic numbers for you because now we have a hard purchase price. We know what the down payment's going to be for you. And these are the loan options that are available to you. So this is how much you can expect to have to bring to closing. The lenders are going to basically decide on the mortgage amount and terms that you can get, and they'll provide this loan estimate, which tells you the loan amount, the interest rate, the monthly mortgage payment, any lender-related fees, and other information. And then we'll go over a loan estimate here just in a second. So if we look at page number 9 on your guide, this just talks about the documents again that you want to have ready. We've kind of already talked about those going back 2 years or 30 days or 2 months on the different assets. These are things that you just want to get together when you're about to sit down and talk to somebody, because they're going to ask this. And I see a question. It says, if a couple was married, then they divorced, how long after the individual divorce should one of them apply for a home loan? Would it be 2 years single, or can they apply immediately after? Typically, you need to have at least, the divorce needs to be final for 30 days. But on a purchase, the other person actually doesn't have to sign anything. So you could you could purchase whenever. There's not really a timeline, because they don't need to be there to sign for the new purchase. But I typically say, for ease of you and documentation, wait until it's 30 days. Everything is said and done. That way there's no ifs, ands, or buts about it. However, I will say, for a first-time home buyer, to be considered a first-time home buyer, you can't have owned a home or had any interest home in 3 years. So if you have a spot, maybe you guys owned a home together, you got divorced, and now you're just renting. If you have 3 years to wait and save up for a down payment for a new purchase, you could be qualified as a first-time home buyer, which just might open more options for you. But that's a very good question. Refinancing is a different thing, but purchasing, there's not really a timeline that you need to follow. All right, so our loan estimate, kind of getting back to that. The loan estimate process can take a little bit longer, just because, again, they're going over all of your documentation. They're doing that final review, because this is now what they're going to be sending you, so that you can realistically know exactly what you're bringing for this exact house and this exact loan product. So if we go to page 10, there's an example of a loan estimate in there. And that is something, I'm jumping ahead, sorry, we're going to look at that here in just a second. But once a lender or lenders present you with the terms and amount of your loan, you're going to need to evaluate whether the offers are good for you and which one to choose. So that loan estimate, like I said, it just breaks down everything that you need to know about your loan. Once your lender has a complete application, and that includes an address, then they have 3 days to send you this loan estimate through initial disclosures. They don't necessarily have to send this to you, again, until they have that complete application, which in a purchase would require you having the address and typically being under contract. But as we look at these, if you're looking at page 10, we'll kind of run through this just really quick. But basically, the top portion of that goes over all of the basic information. You have your date issued, what your names are, where you currently live, the property that you're looking to purchase, the sales price for that property. You have your loan term. This one's a 30-year. It's for a purchase on a fixed rate. This is a conventional loan. And your rate is locked. Typically, your rate lock is good for 60 days with lenders across the board. Then you get into your next section, which kind of breaks down your loan amount, interest rate that you're locked into or maybe floated, and then monthly principal and interest. Something to take note of is you'll see the list of no's. It says, can this amount increase after closing? Your interest rate, that's something you want to double check. If you were doing an ARM, that might say yes, because technically it can. Prepayment penalties, that is definitely something you want to ask about when you're shopping for lenders. Do they have a prepayment penalty? In this case, this loan does. And it tells you exactly or roughly how much it would be if you paid it off within the first 2 years. Something I always like to note with that is you want to double check if they do have a prepayment penalty, does that also include refinancing it with a different lender? Because technically you're paying off that loan. So you might have to pay a fee or a higher payoff in order to get that transferred to somebody else. That's a really good thing to know, or if you plan to make bigger payments than typical to get it paid off early. Balloon payments, this loan doesn't have one. Then you get to your projected payments. You're looking at your principal and interest. That's not going to change from 1 to 30 years. Your mortgage insurance, if you take note on there, that first box, 1 to 7 years, it's $82. And then you don't see it for 8 to 30. because typically private mortgage insurance takes about 5 to 7 years to fall off for your loan to value to reach that point. Estimated escrow, it doesn't change here, but there is a little note that says amount can increase over time. We can't really estimate what property taxes would raise to or what your insurance premium would raise to, so we don't provide that. Then it gives you what your total payment estimated would be from, again, 1 to 7 or 8 to 30 years. Then you get down to your next little box talking about estimated taxes and insurance. In this case, they are escrowing property taxes and insurance, but nothing else. Costs at closing. This is the box to always look at when you're looking at a loan estimate, because this tells you how much you're going to have to come to the table with when you're closing on the home. So closing costs specifically were $80.54, but cash to close is $16,054, which that's including your closing costs as well as your down payment. And then on page 11, this is the sheet that I use the most whenever I'm helping people compare lenders, because it gives a true breakdown of what fees are being charged. Some lenders charge additional fees, others don't. So on here, they're buying down points. They're paying $405 for the rate that they had of 3.875%. Did you know that? That's something to make sure that you're aware of. There is an application fee. There's an underwriting fee. Again, is the other lender you're talking to, do they have these fees? Then it breaks down your appraisal fees, flood certs, all the title fees, recording your taxes, transfer taxes. Those are the government fees that are typically pretty standard. And most of these are going to be estimates when you get this. When you're 3 days prior to closing, that's when you get your hard numbers. That's your closing disclosure. That way you'll know exactly, but this typically lenders are going to overestimate. That way you can prepare for the worst, but this is kind of what this shows. Goes over prepaids if you're establishing your escrow. And then it also points out what you're going to be paying for your escrow, title insurance, what that looks like. Then you get down to credits. Great thing about this is if your seller is willing to pay some of your closing, you'll see those credits in here. If your lender is giving you credits, you'll see those in here. So you can see they're not having, sometimes you can get credit for taking a higher interest rate. So you would see that there. And at the very bottom, you have, again, that estimated cash to close is $16,054. And then that last page of the loan estimate on page number 12, we have here is just kind of additional information. So comparisons, it shows you what you'd be paying in 5 years. Basically, if you just paid everything as is, there weren't any additional payments coming to it. You have your APR right there. Total interest percentage, or your TIP, is on that sheet. Other considerations, you're looking at your appraisal, saying that we're going to order one to evaluate the property. Is the loan assumable? If that's something that's important to you, that's maybe something to double check. Homeowners insurance, it's going to require it. Every loan does. Refinancing, this might specify if you have a certain amount of time before you can refinance, or what it's going to depend on if you do refinance. And then servicing. This is a good box to look at. If you, a lot of lenders will originate a loan and then they sell it. So that if that's something that's important to you, you want to make sure that this is something that they don't do. You want to make sure that box says no. All right, so now that you have a good idea about how the mortgage process works, you're in a better position to plan ahead, to research your options, and make the best choice for your budget. Obviously, there are lots of things that affect the total cost of your mortgage and what you pay each month, your interest rates, your fees, your down payment, that loan term, and more, depending on the lender. But all of those shape how much it's going to cost you to buy this home. So understanding how the home buying process works and researching all the financing options available to you are definitely helpful and critical steps so that you can reach that goal of purchasing a home.
All right, Ryder, thank you so much. That's a lot of great information. I just had 1 or 2 questions that folks had sent in. I think we've got about 4 minutes left. One was on refinancing. It was, they were asking when it's a good idea to refinance and when it's not. Is that something to elaborate on?
Yeah, so my standard is usually if the rate is at least 1% lower than what you're currently paying, that's a good indicator that it's a time to look into refinancing. It also right now, because rates, for example, if you refinance during COVID, I can almost guarantee, unfortunately, you're probably not going to get that rate for maybe another millennia. So that's not a good thing to maybe base it on. But if you're a balance, I've noticed if the balances are lower, like your payoff balance is lower than like 200, 175, it might be worth looking into, especially if you're pulling equity out, because you could always extend that, pull some equity out. Even with a higher rate, your payment might still be the same. So it just depends on the circumstances. But if rate specifically is what you're looking at, I typically say at least 1% lower.
And then was there any differences if you're buying a second home or a vacation home when it comes to mortgages?
There is, yeah. So typically buying a second home, there's certain regulations that classify it as a second home or a vacation. Running theme is that you have to occupy the home for at least 14 days out of the year. So that's something to keep a note. And it typically has to be at least 50 miles from your primary residence for it to be considered a second home. Down payments are typically 5% higher than it would be for a primary. So for example, if you have excellent credit for a primary, it's 5% down, whereas for a second home, it's 10% down. But the rates are typically exactly the same. It's just the down payment requirement and then just the classification of that property are a little bit specific.
That's okay. And then one more, this is interesting. Interest rates, we've seen them drop a little. Any insight?
I don't have a ton to give. I talked to my manager this morning because Rachel kind of gave me a heads up on this, but economists, we watch a lot of webinars with economists and different title companies and rate companies and things like that. And they are forecasting that over the next year, they are going to decrease, not by much from what they're at currently, but they're forecasting that to what, who knows. But that's kind of their, I know a lot of people kind of hinge a lot of dependency on elections and things like that, which not to say historically there has been an impact, but there's no impact. We don't know if it's a good impact or a bad impact. It's kind of hard to say. But one thing I do want to know, I know when the Fed rate dropped, everyone assumed that that mortgage rates dropped and it was a time to refinance. It was a time to go because it had dropped so much. But typically it's actually the anticipation of whatever's going to happen where you'll see the most change. So we were actually, your mortgage rates are dependent on the market. They're actually not very dependent on Fed rate or prime rate. Obviously, we use those to figure out what rates we can offer for each lender, but they're not always an indicator of exactly where the rates are going to go. So leading up to that big drop that the Fed announced they were going to make, rates were slowly dropping. And then they dropped the rate significantly. Everyone thought it was going to change. They actually didn't change. And then 2 weeks later, they've slowly been going back up. So something to think about. It mostly comes back to the market. What is that doing more so than what the Fed and prime rate are showing you?
We do have one question here. When going through the mortgage lending process, is it frowned upon to see that the borrower will be pulling from their 401k as part of the down payment?
It is not. I would definitely suggest looking at making sure that you're talking to the institution that holds that to see if there are penalties associated with pulling out money from your 401k. If you're just pulling funds out, because that could be a bigger penalty than maybe you're ready to pay. And if it is, you might also look into doing a 401k loan, because the loan, they typically just take right out of your paycheck. So we would obviously have to count that. It'd count against your income a little bit, but it's less of a penalty that you'd have to take. But no, I've had that happen before. There's absolutely no issue with that.
Right. Well, I just want to say, Ryder, thank you for taking the time today to do this. We really, really appreciate it. And everybody, thank you for joining us today. This webinar has been recorded, and so we will be posting it on our website in the next week or so. So you're welcome to use it for reference. And I will be sending out a short survey in the next day or two. I would love your feedback. It just takes a minute to fill out. Let's see. Gonna see. I thought maybe we had another question. So our next webinar is on November 6th. And it's going to be how to better care for your family pet, especially around the holidays with traveling and house guests, etc. Our featured speakers will be veterinarian Dr. Amy Shirley, and Michael Shirley. They own Family Pet Health here in Murfreesboro. You can go to mtalumni.com to register. Um, Otherwise, have a wonderful afternoon. You too, Ryder. Thank you again so much.
Thank you, everybody, for coming. I appreciate it. Thanks, Rachel.
Thanks, guys. Bye-bye.
Yeah.